Well, good afternoon or good day, everyone, and thank you for joining me on this short little video, which shares the pro forma financial modeling that we did with the Institute for Southern Georgian Bay, our social finance and housing study group, which has been meeting for the past 2 years. And we're struggling with just understanding what are the financial implications of affordability? How can we create more affordable housing in our communities and thus create more resilient and sustainable communities? So when discussing affordable housing, many of us have difficulties understanding the financial complexity of any building project. Currently, we have many factors that work against affordability. The high cost of construction materials during the pandemic, they shot up. They've come down marginally, but still high cost of construction materials is a factor in building affordability. A shortage of labor resulting in higher costs to find skilled trades, a high cost of vacant land, especially in Ontario. This is a huge challenge in our communities as values are being driven up due to higher densities, but then making it less available for charities and not-for-profits to achieve. Increasing interest rates as the government is trying to rein in inflation. Again, we don't know if this is permanent or temporary, but it does have a factor. It is a factor in determining affordability. And then, of course, demands of investors. As the interest rates go up, investors are looking for higher returns on their investments, such as in real estate investment trusts. However, even with these factors, we believe that it is possible to build affordable housing with collaboration between municipalities, regions, private developers and builders, and not-for-profit housing corporations. The solution doesn't rest in any one of these individual groups, but together we believe that as we collaborate towards a common vision, we can make this possible and make affordable housing, more affordable housing available to a larger segment of our population base. So the financial model attached makes several big assumptions and hence cannot be taken as a business case. That would require a lot more expertise and, of course, costs, which neither of which our group has access to. The other factor, of course, is Ontario's Bill 23. We're not quite sure what the impact of that will be, and hence we did not include that in this pro forma. The financial assumptions that we've talked about are based on real market data. Also, the income deciles in a slide later on, you'll see were produced by NBLC consultants and based on 2016 census data and then extrapolated to estimate 2021 income levels. NBLC consultants did this work for the Collingwood Affordable Housing Task Force in November 2021. Their information is contained in the report that the task force made to Collingwood Council on November 1st, 2021. So it is publicly available. So here's some notes. Municipalities, we have to understand, are essentially not-for-profit entities, and they need to balance their budgets. And of course, with inflation, it's becoming increasingly difficult for them to come in with a 0% increase. Some of them are coming in with 2 or 3% this year, and that's quite okay. Revenues for municipalities come in several forms. Tax levies, of course, realty taxes, development charges, both regional and municipal. And this is basically paid by new developments. And these funds are to be applied to build things like infrastructure, roads, water supply, sewage treatment, and stormwater management, etc. And then, of course, user fees. And then where charges are waived, the revenues have to just be made up elsewhere. And so if development charges are waived, then other developments will have to be paying more, or realty taxes will have to go up. Of course, the other option that municipalities do have at their disposal is the deferral of development charges, which then can be collected either with or without interest at a later date in the event that the property moves out of the affordability category. And when we talk about affordable for life, we prefer into perpetuity, but I think the more common number would be either 30 or 40 years, which is quite significant. The pro forma assumes, of course, that there is net income, that there is a small financial profit in all cases. However, you also have to understand that an astute developer or even a not-for-profit will use several strategies to reduce costs so that they would have net positive annual cash flow, which can then, of course, be used to reduce their debt loads, which then, of course, would translate into lower financing costs. And this is usually achieved through innovative financing or increasing scale. The larger you build, the greater economies of scale you achieve, and thus the more profitability you get. On the financing side, we have assumed 25% equity in a project, and that translates into 75% financing. CMHC insurance is available for multi-unit projects, and for affordable projects, they will reduce the rates by 2%, assuming that you would charge 80% of the market for your rents. Where a not-for-profit developer uses social finance, which is not very common in our community, but it is being done in Toronto and many other communities. Obviously, a social investment bond does require a return, and often lower than bank financing, and can be the risk actually can be offset, can be mitigated if a municipality will provide a first loss guarantee on that particular investment bond. It makes it easier to sell, of course, but also creates more security for the investor. If the not-for-profit developer is a charity, such as Redwood Park Communities, they're building in Barrie right now, or Habitat for Humanity, which builds right across the country, donations are accepted, for which charitable tax receipts are issued, and thus lowering the finance costs and improving affordability. There's also the concept of a hybrid model, and we actually promote this. It does create, I think, more holistic communities rather than ghettos, which is one of the common factors that people use when they complain about affordability. And so, again, a hybrid model makes the project more sustainable and, I think, a greater asset in the community. And so you go mixed use. You can do ground floor commercial, which would attract higher rents per square foot, often at a greater risk to the landlord, but if properly managed, can be well run. Of course, a daycare center will be a benefit to the larger community as well, and is an income producer. Mixed income levels, a project can be more feasible if there is a mixture of market rent. You can do 20% lower than market, 30% lower than market, etc. And then, of course, reduced rents would attract to more favorable CMHC financing rates and greater possibility for municipal concessions. So the summary page at the end of the presentation shows two scenarios, one which assumes that the whole project is affordable rents, and one which shows that 50% are affordable and the other 50% at market. There are also alternative financing models. There are some options available that you might be aware of. We've mentioned earlier community investment bonds. Vancity Community Investment Bank is big in the affordable housing space, as is Newmarket Funds, which is a capital market. They attract funds from the capital market and invest it in communities, many times in affordable housing projects. So here we have the household incomes in the town of Collingwood, and then the affordability thresholds. And so we've broken it down between the 9 decile groups, where 1 is the lowest and 9 is the highest. And these are based on 2016 incomes, then extrapolated to become 2021. Once the 2021 numbers are available from Census Canada, from Stats Canada, then we will update these numbers. But I think they're fairly accurate. And it's interesting to note that owner income is generally twice renter income. And so you have to distinguish between the two when you decide what you're going to build. You're going to build affordable rentals or affordable housing. So taking a look at the moderate income, and that's really what we are targeting here, the 4th to the 6th income decile. The highest income deciles, again, can afford $1,500 a month rent. At the 8th decile is $1,800, and the 9th, $2,400. But let's take a look right down the middle at the 5th decile group, where the owner income would be on average $83,000, renter income $43,000, where the affordable rental rate is then only $1,084 based on 30% of gross income towards accommodation. and that person could afford in that fifth decile group, could afford a house in the $314,000 range. And we know that those properties are simply not available right now. So we do need to look at how we can produce more affordable housing so that we can reach a larger percentage of our population. And so here we have the actual numbers. Now, this is backed with spreadsheets, et cetera. So I'm not showing you all the details. But so the first column first line, for instance, would be a pro forma on with market rents only, and it's based on an actual project that was built in Collingwood. I think it was completed 2 years ago. These were the rents that were being advertised at the time. I know that they are higher now. And so, again, I can only go by numbers that I had available to me. And so, yeah, a one-bedroom rented market would be $1,500, a two-bedroom at $2,300. And this project would achieve about $29,000 net income, and it would target the 7th to the 9th affordability threshold, so the highest affordability thresholds. Municipalities have land that can be available, and they could donate this, or philanthropists could donate land in exchange for a tax receipt if you're dealing with a not-for-profit charity. They could, with zero land, like basically with donated land, we could drop the rents by about 10%. So basically charge 90% of market rents. And as a result, you would be able to target the 6th to the 8th affordability threshold. Providing zero land costs and waiving development charges by the municipalities, you can drop your market rents down to 85% of market. And again, you'll see the column that shows 100% affordable would still show a profit of $19,000. If you were to do a mixed 50-50, so 50% market, 50% affordable, again, at the 85% level, you would still be profitable, and you would again be targeting the 6th to the 8th affordability threshold. Zero land, waive development charges, 2% financing discount. You can bring that all the way down to the 60% of market. And the biggest bang for your buck really is your financing costs. And if you can reduce that by 2%, that's where you get the biggest jump in terms of affordability. And so, again, you're targeting now the 4th to the 6th affordability threshold. And you can see your profit basically doubles if you do a mixed income, and so, or mixed rental. So again, 50% affordable, 50%. So 50% at 60% of market, and the other 50% at 100% of market. And then, of course, another option is, in addition to all of this, would be waiving or reducing realty taxes by 50% for the affordable units. And that, again, brings you down. You can charge 55% of the market and achieve, again, your 4th to the 6th affordability threshold. So I hope that this can show you that indeed it is possible to build affordable housing. However, I'm going to reiterate that this is not a solution that one party can only provide. It needs the collaboration of all parties with the common vision of creating sustainable communities where there is housing for everyone, and where we respect the human dignity for all people, and the UN philosophy, the human rights philosophy, that everyone deserves good, safe, and affordable housing. And so let's work towards that and get something built. Thank you very much for your time.